In today's video, we are doing a deep dive into pharmaceutical accounting, covering the complete business flow, end-to-end accounting treatment, real-world journal entries, financial statement impact, common errors, and the kind of interview questions that companies actually ask. Whether you are preparing for a job interview, working in finance, or just building your accounting foundation, stay with us, because this video covers everything. In this section, we will go through all the key concepts of business understanding in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Cipla Pharmaceuticals is a leading global pharmaceutical company from India, known for its generic medications. The industry is vast, with billions in global revenue, dominated by players like Pfizer, Novartis, and Roche. Cipla competes by focusing on affordable, accessible healthcare, especially in emerging markets. Understanding the scale and competition helps frame the financial strategies that impact profitability and compliance. Cipla generates revenue primarily through the sale of generic drugs, which are cost-effective alternatives to branded medications. Major cost drivers include research and development, regulatory compliance, and manufacturing. Understanding these revenue streams and cost factors is crucial for accurate financial planning and control. This model supports Cipla's aim to provide affordable healthcare solutions globally, ensuring their competitive edge and sustainable growth. In Cipla, finance operations, procurement, and legal departments play crucial roles in accounting. Finance handles budgeting and financial reporting, while operations ensure cost-effective manufacturing. Procurement manages supplier contracts and raw material costs, and legal oversees compliance with regulations. Each department's function impacts financial statements, influencing Cipla's profitability and compliance. Understanding their roles ensures accurate accounting and effective decision-making. Understanding the workflow in Cipla is crucial for efficient operations. The process starts with R&D, progressing to procurement for material acquisition. Manufacturing follows, producing the final products. Distribution then channels products to markets, and feedback from customers informs future improvements. Each step is interlinked, requiring precise coordination to ensure efficiency and quality, impacting financial results and market competitiveness. Cipla's stakeholders include clients, vendors, governments, banks, and regulators, each influencing accounting practices. Clients drive sales and revenue, while vendor relationships impact cost management. Government and regulators enforce compliance, affecting financial reporting. Banks provide financing, influencing cash flow and capital structure. Understanding these relationships is vital for accurate financial planning and maintaining Cipla's reputation and operational success. Pharmaceutical accounting faces unique challenges such as a lengthy working capital cycle, complex contracts, and strict regulatory requirements. The working capital cycle is extended due to long R&D and approval processes. Contractual complexities arise from collaborations and partnerships. Regulatory demands require meticulous compliance, impacting financial disclosures and operating costs. Addressing these challenges is crucial for Cipla's financial stability and regulatory compliance. Pharmaceutical accounting is unique due to R&D capitalization, patent amortization, and inventory valuation methods. R&D costs are often capitalized, reflecting long-term investment. Patents are amortized over their useful life, influencing intangible asset management. Inventory valuation can be complex due to variable production costs. Understanding these nuances ensures accurate financial statements and strategic decision-making, crucial for companies like Cipla navigating the competitive pharmaceutical landscape. In Cipla, accounting entries are primarily handled by the finance team, triggered by transactions such as sales, purchases, and expenses. This process involves ensuring accuracy and compliance with accounting standards. Timely entry ensures up-to-date financial records, aiding strategic decisions. Understanding the trigger points and responsible teams is crucial for maintaining financial integrity and operational efficiency. In this section, we will delve into the intricate accounting process in the pharmaceutical industry, using Cipla Pharmaceuticals as our example. Understanding this end-to-end process is crucial for managing financial health and ensuring compliance with industry standards. From initiating a tender to closing the financial period, each step plays a vital role in maintaining accurate and transparent financial records. Let's explore these steps in detail. The accounting process begins with the initiation of a tender or order requisition, typically handled by the procurement department. This step involves identifying the need for raw materials or products. Procurement managers prepare a requisition document using systems like SAP. This triggers a need for funds allocation, recorded in the accounting system. Errors here can cause mismatched inventory orders, leading to production delays. Once a requisition is created, it must pass through an approval process. This involves department heads and sometimes finance managers, ensuring the purchase aligns with budgetary constraints. Approval is documented within the ERP system, triggering accounting entries for projected expenses. Delays or errors in approval can cause financial discrepancies and affect project timelines. Following approval, a purchase order (PO) or contract is issued to the supplier. The procurement team manages this, ensuring terms like quantity, price, and delivery dates are recorded accurately in the ERP. This step creates a commitment in the accounting system, crucial for cash flow planning. Mistakes in contract details can lead to disputes and financial losses. In some cases, an advance payment is required before goods are delivered. The finance department handles this, ensuring payments are processed correctly and logged in the financial records. Advance payments are crucial for securing supply commitments, but mismanagement can result in cash flow issues or supplier disputes. Upon receipt of goods or services, the warehouse and quality control teams perform checks to confirm compliance with order specifications. A goods receipt note, GRN, is generated, documenting the receipt in the inventory system. This step completes the procurement cycle, triggering entries in inventory accounts. Errors in this stage, such as mismatched deliveries, can cause inventory discrepancies and affect production schedules. After goods receipt, suppliers issue an invoice, which is verified against the PO and GRN by the accounts payable team. This ensures accuracy before payment processing. The invoice is recorded in the accounting system, setting the stage for payment. Misalignments between the invoice and received goods can cause payment delays and supplier dissatisfaction. The payment process involves the finance department executing payments to suppliers based on verified invoices. Ensuring timely payments maintains supplier relationships and avoids late fees. Payments are recorded in the accounts payable ledger. Errors, such as incorrect payment amounts, can strain supplier relations and lead to financial penalties. At the end of each financial period, reconciliation ensures all transactions are accurately recorded. The finance team reconciles bank statements with accounting records, resolving discrepancies. This step is crucial for accurate financial reporting and compliance. Failure to reconcile can lead to financial misstatements and regulatory issues. In this section, we will go through all the key concepts of accounting concepts in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Revenue recognition is a critical accounting concept where revenue is recognized when control of goods or services transfers to the customer. In the pharmaceutical industry, this is crucial due to complex licensing, multi-year contracts, and sales agreements. Indian Accounting Standard 115 and International Financial Reporting Standards 15 govern this, requiring companies to account for variable considerations like rebates and multiple performance obligations typical in drug licensing. For example, Cipla Pharmaceuticals must recognize revenue from drug licenses when control is transferred, even if payments are received later. This differs from general accounting by focusing heavily on performance obligations and customer control transfer. Inventory valuation is the process of determining the cost of goods sold and the value of ending inventory. In pharmaceuticals, this is vital due to high research and development costs and intricate production processes. Indian Accounting Standard 2 and International Financial Reporting Standards 2 guide this, requiring the use of methods like LIFO, FIFO, or weighted average to ensure accurate cost reporting. For instance, Cipla needs to select an inventory valuation method that reflects true cost flows to avoid misstating profits. This is more complex in pharma due to high-value, perishable inventory. Fixed assets and their depreciation are crucial for allocating the cost of an asset over its useful life. In the pharmaceutical industry, this is significant due to substantial investments in R&D equipment and manufacturing facilities. Indian Accounting Standards 16 and International Financial Reporting Standards 16 provide the framework, requiring companies to choose appropriate depreciation methods like straight line or units of production. For example, CIPLA may use the units of production method for specialized drug manufacturing equipment. This differs from general accounting by focusing more on R&D-specific assets. Lease accounting involves recognizing lease liabilities and right-of-use assets on the balance sheet. This is particularly important for pharmaceutical companies, which may lease laboratory and office spaces to manage costs. Indian Accounting Standard 116 and International Financial Reporting Standards 16 govern this by requiring lessees to recognize assets and liabilities for nearly all leases, moving away from the traditional off-balance sheet model. For CIPLA, this means accounting for leased research labs as assets, impacting financial statements significantly. This diverges from general accounting where short-term leases might not be capitalized. Contract accounting and work in progress, WIP, are about recording ongoing project costs and revenues. In pharmaceuticals, this is vital for long-term drug development contracts that span years. Indian Accounting Standard 11 and International Financial Reporting Standards 15 provide guidelines, requiring companies to recognize revenue and costs progressively over the contract's life. For example, CIPLA must account for ongoing clinical trial costs, recognizing them as incurred. This is more complex than general accounting due to the high uncertainty and duration of pharmaceutical projects. Provisions and contingencies deal with recognizing future liabilities and uncertainties. In the pharmaceutical sector, this is critical due to potential litigation, product recalls, and regulatory fines. Indian Accounting Standard 37 and International Financial Reporting Standards 37 govern these, requiring companies to recognize probable outflows as liabilities when they can be reliably estimated. For instance, CIPLA may need to provision for potential lawsuit settlements related to drug side effects. This differs from general accounting by the high stakes and frequency of legal issues in pharmaceuticals. Foreign currency transactions involve dealing with financial events in currencies other than the functional currency. For global pharmaceutical giants like CIPLA, which engage in cross-border sales and operations, managing these transactions is essential. Indian Accounting Standard 21 and International Financial Reporting Standards 21 govern this, requiring companies to translate foreign transactions into their functional currency, addressing exchange rate fluctuations. This is more complex in pharmaceuticals due to the vast geographic sales and diverse currency exposures, impacting profitability and cash flow. Deferred revenue pertains to recognizing revenue that has been received but not yet earned. This is crucial for pharmaceutical companies due to prepaid licensing fees and long-term contracts. Indian Accounting Standard 115 and International Financial Reporting Standards 15 govern this, requiring revenue to be recognized over time as performance obligations are met. For example, CIPLA must defer recognizing prepaid licensing fees until the drug is delivered or the service provided. This differs from general accounting by frequently involving substantial amounts and multi-year timelines. Cost allocation is about distributing costs to various departments or products for accurate financial reporting. In pharmaceuticals, this is vital for tracking R&D and production costs effectively, as these can significantly affect pricing and profitability. Though primarily guided by management accounting principles, precise allocation methods like activity-based costing are needed. For example, CIPLA must allocate R&D expenses accurately across various drug development projects. This is more intricate than general accounting due to high costs and the need for detailed tracking in pharma R&D. In this section, we will go through all the key concepts of journal entries in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. This entry records the initial capital infusion from shareholders, increasing both assets and equity. Capital from shareholders is crucial for starting operations, as it provides the necessary resources to acquire materials and pay for other startup costs. This transaction reflects trust from investors in CIPLA's potential to grow. Purchasing raw materials is vital for any pharmaceutical company to start production. Although purchased on credit, This allows Cipla to manage cash flows effectively while ensuring the availability of necessary resources. This entry increases assets and liabilities, highlighting the importance of credit facilities in operational efficiency. This entry signifies the start of the manufacturing process, where raw materials are transformed into work-in-progress inventory. By moving materials to production, Cipla begins converting inputs into valuable products. This highlights how the transformation process is tracked financially, impacting both inventory accounts but not affecting overall asset value. Completing the production process, Cipla moves products to finished goods, ready for sale. Recognizing revenue acknowledges the economic benefits from sales, impacting both assets and revenue. These entries highlight the conversion of production efforts into financial gain, crucial for showing business growth and success in market penetration. This entry records the collection of payment from customers, converting receivables into cash. It illustrates the cash cycle's completion, essential for business liquidity and subsequent investments. Timely collections are vital for maintaining healthy cash flows, allowing Cipla to sustain operations and potentially expand production capabilities. Paying suppliers is crucial for maintaining strong relationships and ensuring future credit terms. This transaction reduces Cipla's liabilities and cash reserves, emphasizing the importance of managing accounts payable to sustain production and avoid supply chain disruptions. Effective supplier payments maintain the cycle of production and financial health. Recording payroll expenses is critical, as it represents a significant operational cost, directly impacting profitability. Paying employees timely ensures motivation and retention, which are crucial for maintaining production quality and efficiency. This transaction reduces cash, but is essential for workforce stability and operational continuity. Depreciation accounts for the reduction in value of manufacturing equipment over time, reflecting wear and tear. This non-cash expense is crucial for matching the cost of equipment use to the revenues it helps generate. Recognizing depreciation affects profitability, but not cash flow, ensuring accurate asset valuation and financial reporting. Accruing interest expense on loans is vital for reflecting the true cost of borrowing over time. It increases liabilities without immediate cash outflow, highlighting the obligation to lenders. This entry is crucial for accurate financial reporting and planning, ensuring that Cipla's earnings reflect all incurred costs. Year-end financial reporting involves closing temporary accounts to prepare financial statements. Closing revenue and expense accounts to the income summary ensures accurate profit calculation for the period. This process is fundamental for resetting accounts for the new fiscal year, aiding in performance assessment and strategic planning. In this section, we will go through all the key concepts of financial statement impact in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In Cipla Pharmaceuticals, current assets like accounts receivable and inventory show how efficiently the company manages sales and production. When sales increase, accounts receivable rise, impacting cash flow. Inventory management affects production costs and supply chain efficiency. Similarly, current liabilities such as accounts payable and short-term debt reflect the company's credit terms with suppliers and financing strategies, which are crucial for maintaining liquidity and operational flexibility. For Cipla Pharmaceuticals, non-current assets such as property, plant, and equipment, and intangible assets like patents represent long-term investments critical for sustained growth. These assets require significant capital but yield long-term returns. Share capital and retained earnings and equity show investor confidence and profit reinvestment, essential for funding research and development in the pharmaceutical sector. Balancing these accounts ensures robust infrastructure and market competitiveness. Cipla Pharmaceuticals sales revenue indicates market demand and pricing strategy effectiveness. Cost of goods sold, COGS, reflects the direct cost of production, impacting gross profit. Maintaining a healthy gross profit margin is crucial for covering operating expenses and investing in new drug development. Efficient cost management ensures competitive pricing and profitability, key in the pharmaceutical industry where research and production costs are significant. Operating expenses in Cipla Pharmaceuticals include R&D, marketing, and administrative costs, essential for strategic growth and market presence. EBITDA highlights operational efficiency by excluding non-operating factors, providing a clearer picture of core profitability. Profit before tax assesses overall financial performance, factoring in interest and other income. These metrics are crucial for investors evaluating the company's capacity to generate sustainable profits and grow in a competitive market. Cipla Pharmaceuticals' cash flow from operating activities shows the cash generated from core business functions, crucial for sustaining daily operations. Investing cash flows often reflect capital expenditures for growth, such as new equipment or facilities, which can initially decrease cash but aim for future profitability. Financing cash flows indicate how the company raises capital, whether through debt or equity, impacting its financial leverage and ability to fund strategic initiatives. For Cipla Pharmaceuticals, the current ratio indicates liquidity, essential for meeting short-term obligations. A lower debt-to-equity ratio suggests reduced financial risk, appealing to investors wary of over-leverage. A higher gross margin reflects efficient cost management and pricing power, vital for maintaining profitability. R&D intensity measures innovation investment, crucial for developing new drugs and staying competitive. These ratios provide insights into operational efficiency, financial health, and strategic priorities. In this section, we will go through all the key concepts of common errors in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In pharmaceuticals, precise inventory valuation is crucial, as drugs tend to have expiration dates and specific storage conditions. Errors often arise from incorrect application of cost formulas like FIFO or LIFO, which can lead to misreported profits. An auditor would scrutinize inventory records and physical counts to ensure compliance with IAS 2. Correct valuation ensures accurate reporting of cost of goods sold and impacts net income and tax obligations. Interview traps often involve revenue recognition, especially under International Financial Reporting Standards 15. In pharmaceuticals, revenue should be recognized when control of goods transfers to the customer, not merely when an order is placed. Missteps here can inflate or deflate earnings unjustly, impacting investor decisions. During audits, entries are reviewed against contracts and delivery records to verify compliance. Mastery of this principle is essential for accurate interim and annual reporting, maintaining transparency and investor confidence. ERP systems are integral in pharmaceutical accounting, but data entry errors can lead to significant inaccuracies. For instance, misrecording a batch size or sales price affects inventory management and financial forecasting. Such errors often arise from lack of training or oversight. Auditors can detect these discrepancies by cross-referencing ERP entries with physical records and contracts. Correcting these prevents cascading errors in financial statements, ensuring reliable management reporting and decision-making. Cutoff errors in pharmaceuticals can significantly misstate financial health, especially around period end. Incorrectly recognizing sales or expenses either before or after the fiscal period distorts true performance. Such errors are often inadvertent but result from poor coordination between accounting and operations. Auditors look for these by reconciling transaction dates with supporting documentation. Proper cutoff ensures that income and expenses are matched, providing an accurate view of profitability and financial position. Standard switching errors are common in global companies like Cipla Pharmaceuticals, which must navigate between international financial reporting standards and generally accepted accounting principles. Misinterpretations can lead to mistakes in revenue recognition or lease accounting, affecting financial comparability. These errors typically occur during mergers, acquisitions, or global expansions. Auditors examine these transitions carefully to ensure correct treatment and compliance. Understanding the nuances of each standard is vital to maintaining accuracy in international financial reporting and ensuring stakeholder trust. In this section, we will go through all the key concepts of interview questions in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. International Financial Reporting Standards 15 modifies revenue recognition by focusing on the transfer of control rather than risks and rewards. In pharmaceuticals, like Cipla, revenue is recognized when control of a drug is transferred, often at delivery. Understanding contract specifics, such as rebates or returns, is crucial for accurate recognition. This ensures compliance and accurate reporting, ultimately impacting financial statements and investor decisions. For CIPLA, under International Financial Reporting Standards, research costs are expensed and not capitalized. Development costs can be capitalized if they meet recognition criteria like technical feasibility and future economic benefits. The journal entry for capitalizing development costs is debit intangible assets and credit cash or accounts payable. This treatment reflects potential future benefits and aligns with accounting standards, improving transparency and comparability. CIPLA values inventory at the lower of cost and net realizable value. Cost includes purchase price and any cost directly attributable to bringing the inventory to its present location and condition. Net realizable value is the estimated selling price minus selling costs. This valuation method ensures that inventory is not overstated in financial statements, maintaining accurate asset valuation and financial health reflection. Indian Accounting Standard 38 governs the accounting for intangible assets, including patents and trademarks in pharmaceuticals. CIPLA applies Indian Accounting Standard 38 to recognize intangible assets only if it's probable that they will generate future economic benefits, and costs can be reliably measured. This ensures that intangible assets are neither understated nor overstated, impacting the company's valuation and investor confidence. CIPLA employs SAP for integrated financial reporting and inventory management, enhancing accuracy and efficiency. SAP provides real-time data across departments, ensuring consistent inventory levels and financial integrity. This system helps in tracking drug batches, managing costs, and complying with regulatory standards, ultimately supporting strategic decision-making and operational efficiency within CIPLA. Exchange rate fluctuations impact CIPLA's financial statements primarily through the translation of foreign operations and transactions. Gains or losses from currency movements can affect revenue and expense reporting, impacting net income. These fluctuations may also affect balance sheet items, such as foreign currency-denominated receivables and payables, requiring careful hedging strategies to mitigate financial risks. Deferred tax in CIPLA arises due to differences between accounting and tax treatments, such as depreciation methods. Recognized in accordance with Indian Accounting Standard 12, deferred tax assets and liabilities reflect future tax consequences. Proper recognition ensures accurate future tax liability estimation and compliance, impacting cash flow predictions and financial planning. Under International Financial Reporting Standards, CIPLA accounts for licensing revenue by recognizing income as the performance obligations are satisfied. If a license provides a right to use, revenue is recognized at a point in time. If a right to access is provided, revenue is recognized over time. This ensures that revenue reflects the economic substance of the transaction, aligning with International Financial Reporting Standards 15 and providing clarity to stakeholders. CIPLA treats clinical trial costs as research expenses, expensed as incurred, unless they meet the criteria for capitalization under development costs. This approach aligns with Indian Accounting Standard 38, ensuring costs are matched with future benefits only when certain. This treatment impacts profitability reporting and aligns with the principle of conservatism, preventing overstatement of assets. CIPLA follows Indian Accounting Standard 37, recognizing a provision for contingent liabilities if an outflow of resources is probable and can be reliably estimated. For patent disputes, disclosures are required even if a provision isn't recognized, providing transparency and informing stakeholders about potential financial impacts. This ensures that financial statements reflect potential risks adequately. Understanding CIPLA's business model and processes helps grasp the financial impacts on statements. Their focus on generics means cost efficiency is key, while R&D investments highlight future growth potential. Supply chain and regulatory compliance are critical, influencing everything from pricing strategies to market entry. This holistic view ensures we understand how each business component affects the financial health and strategic positioning within the pharmaceutical industry. In pharmaceutical accounting, recognizing revenue at the right time is crucial for accurate financial statements. CIPLA must carefully allocate costs to reflect true production costs and profitability. Inventory methods like FIFO affect financial outcomes, while R&D costs are capitalized for future benefits. Depreciation choices impact both taxes and net income. Additionally, foreign exchange and lease accounting complexities add layers to understanding CIPLA's financial health and strategic decision-making. When preparing for a pharmaceutical industry interview, focus on regulatory knowledge, especially FDA and EMA guidelines, as compliance is vital. Be fluent in financial metrics to articulate CIPLA's profitability. Discuss cost management strategies for operational efficiency and the impact of innovation on growth. Stay informed on global trends affecting the industry and the strategic role of partnerships. Lastly, be prepared to address ethical considerations, which are crucial for maintaining industry credibility and trust. That is your complete guide to this topic. If this video helped you, please like and share it. It genuinely helps us keep creating content like this. Drop your topic requests in the comments below. Subscribe to Candy Mentor for more finance and accounting videos. We will see you in the next one.